Hi everyone, I'm Alex Gajevic. I'm a professor of political science at Université Laval. Very happy to be here presenting at the Climate Futures Workshop. I'll be presenting on the energy transition, market trends, and political decisions. I'll be including a lot of text and references in the PowerPoint so that you have a lot of information and also to encourage feedback. And feedback would be really appreciated as this is the beginning of a new paper. First, just to get it out of the way, what is a political theorist? Looking at market trends, some may ask. Part of the reason really why comes from my general position in an ideal political theory, according to which real-world practices really reveal no relevance, which are relevant for the formulation of normative duties. So in terms of methods, I'm going to be adopting in this paper a normative approach that is based on the reading of energy markets. So right now there are signals from the energy markets that the energy transition is underway. Recent behavior of investments around the world indicate that the transition away from fossil fuels is very much on their minds. However, the exact pace of the transition is uncertain, and climate imperatives require that transition away from fossil fuels be accelerated. So this paper looks at the potential for accelerating the transition by considering a few key market trends and the political decisions that should arise in this context. Essentially, my claim is twofold. So first, energy markets reveal how they can make it overall easier to act upon climate change. And secondly, that specific market trends can enlighten specific policy, which would be helpful to accelerate the transition. So let's look at these two claims throughout the paper. First, just to finish, market trends going in the right direction, just to clarify, can help those who won't primarily act based on the moral duties to act upon climate change. So overall, we can say that these trends can help make it easier for those who wish to fulfill their moral duties to do so. So if that is really the case, political decision makers should make sure they will harness the power of the market. So obviously, not all market trends do that, but since some do, well, these are the trends that political decision makers should be looking at and really looking to harness their power. First, just to begin, a definition of the energy transition. I think that is important. So generally, the energy transition is first and foremost understood as a change in the primarily composition of the primary offer of energy. It also refers to the transformation of energy markets, institutions, and infrastructure. Generally, we understand that once completed, the transition renders it impossible a return to previous modes of production. At this stage right now, the transition implies a fast growth of alternatives despite an entire system which is formatted for the use of fossil fuels, a system that is characterized by what we know as a carbon lock-in. And moreover, I think it is important to understand the transition right now. We should understand it in terms of the decarbonization of the energy sectors, following the greenhouse gas emission targets set up by our most prominent scientific agencies such as the IPCC. So that is right now the net zero target for 2050 and a 45% reduction, we could say, before 2030. So that would be like the general understanding of the energy transition that I have in this paper. Just to understand where we are right now in this transition, let's look at the renewables in the global energy mix today. From the global, so we see articles on that quite often, like that, wind and solar is overtaking gas and coal, for instance. So these are regularly found in news cycles. I'm gonna look first at the global level where we are right now, specifically just to give you an idea in the electricity sector. Non-hydro renewables account for 9% of all power in the first quarter of 2020, so a year ago. That is a 1% increase in a single year from 2019. If we want to look at the US, for instance, we were at 11.5% of total electricity produced in the US from wind and solar, which is an overall increase of 2% from 2019. And combined with the other energy sources, all renewables in the US in 2020 provided 20.8% of the total electricity output. So it gives us an idea of where we are right now. And looking at total renewables for the electricity sector again in Europe, we can see actually for the first time in 2020, renewables overtook fossil fuels in the production of electricity. So these are good news, and the general trend is that renewable energy will continue to grow. Bloomberg predicts that renewables, including hydro, will generate 50% of the world's electricity in just 10 years from now, in 2030. It's in comparison to 24% in total in 2019. So this is a massive increase over the next 10 years. So that is a bold prediction. It will be challenging, but not entirely inconceivable, considering that renewables are available in one form or another almost everywhere on the planet. So this is a bit for solar. So this gives us a good idea of where we find solar energy, or where we could find solar energy everywhere on the planet. So of course we can look at the American Southwest and Florida. Really good potential here. This is for wind. We can look at the American Midwest, for instance. We know it is windy out there, but also many other places in the world. So basically between solar and wind, we find these two energy sources pretty much everywhere on the planet. So this is why we get such a bold prediction, but this would be an incredibly important trend to follow. So I'm going to follow here 7 trends. We're just going to go over them quite quickly, but to give us an idea of where market trends on the energy transition are right now. There are many other trends. I just picked on the 7 ones. They are somewhat sufficient just to prove my point in this paper. But again, as I said, I'm still working on these elements. So let's look at these 7 trends one after the other. So first of all, investment in renewables. So quite important here. In 2018, for instance, just to give you an idea, renewables, non-hydro investments. So investments in renewables, non-hydro, were already almost at 60% of all investments in new energy projects in 2018. So there was over $260 billion invested in new energy projects around the world. In 2020, we already went over 300 billion, even 350 billion according to some sources. Bloomberg and the IEA did not give the same data here, but in both cases we see an increase of total renewable investments year after year. So this is relevant. We keep this in mind. Second very important point, and this is a pretty big point, is the question of returns on investment. Because recently, while investments in renewable were up, returns on investment were not as large as returns from fossil fuel investment. And this tide is changing, and this is pretty big. So clean energy shares are setting new records. We can actually look at the next index up a remarkable 142% from 2020. So that is a really big really big increase, and the outperformance of the next index compared to the New York Stock Exchange ARCA Oil Index was a non-performance of 180 points. So pretty massive trend here for clean energy, and this is pretty new. So investors' reaction to the effects of COVID has had a positive effect on clean energy stock returns, and this similar effect was not apparent from fossil fuel firms. So that is pretty big. So I'm noting here, look, there are a few sources for you if you want to check out, but generally the idea is that there is a superior financial performance for clean energy firms during the global pandemic in particular, and some other sources show that the renewables power share offered investors higher total returns relative to fossil fuels. So basically, this is so these different sources are pretty much confirming this idea. So this second trend is pretty important. Looking at the third trend right now. the pressure to report. I think some of you might be familiar with this topic as well. So there's a growing pressure for companies to report on climate risks and environmental impact. We saw that the UK intention to mandate climate disclosures by large companies and financial institutions. So that is also a very important point. And the recent international effort has indeed focused on improving access to information by supporting the disclosure of climate-related risks by private actors. I note here that the French energy transition law goes actually even further and requires that banks conduct climate-related stress testing. So that's pretty interesting. And here we can sort of try to make this kind of analysis of market insights that are relevant for political decision making. Perhaps government should implement mandatory climate-related stress testing by banks. So actually going even further than just the asking for reporting on climate risks. So this is the kind of analysis that we can, okay, this is where we are right now, and perhaps going even further. That's the kind of policy and political decisions that could actually be demanded really to harness the power of the market. So this is one example. Another trend that is important, I think many of you are familiar with this topic, investments under ESG guidelines. So very quickly, I guess you probably know that investment under ESG guidelines is accelerating, and global ESG assets are on track just by 2025 to represent more than a third of total assets under management. So that is pretty considerable. A fifth trend that I want to look at is the increased risk of stranded assets. So the oil market is showing some signs of recovery in 2021, but the overwhelming trend is kind of negative. So concerns about stranded assets are beginning to have an impact, and you can read, so there are various sources again here for you, but generally the notion is that the risk posed by stranded assets are rapidly climbing the investors' industry agenda. So that is massively important, and part of the stranded assets fossil fuels would occur as a result of an already ongoing technological transition, whether or not new climate policies are adopted, and therefore we can note actually the loss will be amplified if new climate policy to reach the 2 degree Celsius target, and actually even the 1.5 degrees Celsius target were adopted. This loss will be even amplified. So another market insight for political decision making here is that climate policy will increase the volume of stranded assets, and institutional investors in particular need, of course, a divestment strategy. Otherwise, institutional investors will be betting against climate policy. So again, very important for us here to analyze market and political decision making in parallel. All right, so sixth market trend that I wanted to look at. I think some of you might have heard it, but the renewables price drop. So fossil fuels are no longer the cheapest energy sources available within the last decade. So you look here, this graph between 2009 and 2019. Within the last decade, renewables became the cheapest energy sources in most places in the world, and they now undercut fossil fuels simply based on price. In many places, including many places in the US, in California, in Texas, in the prairies, and in the South. And this gives us another market insight, and this really is an argument for investments into scaling up renewable technologies right now. So these new prices and the kilowatt hour in many places is lower for fossil fuels than for is lower for renewables than for fossil fuels. In many places, actually, the Department of Energy has already released data that goes also in that. The U.S. Department of Energy has released data that goes in that direction. And finally, the last market trend I want to look, and that is also very, very important for political decision making, is the notion that demand has peaked or is peaking. So coal demand has already peaked. Peaks in demand for oil and gas are coming. So this McKinsey report says that respectively in 2029 and 2037, these speeds are coming, if not early, given potential new policy implemented. It does not mean that oil and gas markets will collapse overnight, but it does mean that at least there is no new new supply sources, and actually that is a very, very important milestone that was put forward by the IEA in their latest report. And the idea is that to guide the global journey to net zero emissions by 2050, the IEA milestones include no new investments in new fossil fuel supply projects from 2021, so from this year. So there is really good information for what should be on the minds of political decision makers. So I already did a lot of the analysis that I want to do, just to give like these examples. Just let me go over a few less elements to finish. Of course, you might know that a series of political decisions will be necessary to accelerate the transition, in particular because many forces are still holding back the transition. And we may ask a few questions relevant in this context here, but will banks use COVID-19 as an excuse to push back against rules such as climate stress tests and even climate-related disclosures? So this is something we're going to need to follow, and we're going to need to see if politicians are going to follow through with this, with asking for climate-related disclosures, for instance. We're also going to need to see how many new fossil fuel production projects will be funded. Of course, seeing that the trends that we just saw, and seeing that the demand is going to peak, we know that fossil fuel projects invested today, they're going to be ready in 5 years at the earliest, and they're going to be actually functioning for over 50 years. So are there big risks here of stranded assets of new fossil fuel projects, and how many are still being funded today? So this is a huge issue for today. And also, institutional investors are reducing the fossil fuel portion of their portfolios. I think there's a general trend here, but how long will they really still hold large portions of their portfolios in oil or gas? So this is pretty important for us to look at going forward. Just let me go over. So obviously, sustainable finance commitments are really generally very important, as we just seen. So the EU has committed to the green economy. We can say this will require the last regulations that will come in force, that just came into force in March. We require financial advisors to incorporate sustainable risk considerations into their diligent process. So this is very important. We know also that the U.S. is committed to the Paris Agreement again, and the new Joe Biden plan for $2 trillion investment in infrastructure and energy is going to create a lot of growth for the clean tech sector in America. But going forward, how can we think about tilting the field really to accelerate the transition? So given current and planned policies, it is unclear whether the share in renewables will grow such as to meet the IEA sustainable development scenarios. And we're obviously not on track actually to decrease our emissions such as to meet the greenhouse gas reduction targets that we need to meet. So how can policy contribute to tilting the playing field? So climate commitments, new Green New Deals, Building Back Better, all these plans will send strong signals to the market, which is massively important. And also precise legislation could build up on the market. So some of the examples that I already gave could build up on the market momentum and accelerate the transition. So let me go over. So really good news. So on this very topic, just a few days ago, that the G7 countries backed moves to force banking companies to disclose their exposure to climate risk. So we saw in their final communique that they support moving towards mandatory climate-related financial disclosures. So that is extremely important. And so going beyond, so we saw that the Canada LEAF which provides actually financing for large Canadian businesses, require them to publish annual climate-related financial disclosure. So that's also important. But going forward, as I said, governments should perhaps be looking at implementing mandatory climate-related stress testing by financial institutions, so banks and other financial institutions. And in June 2021, the Bank of England set out its first complete stress test. So the Bank of England is doing it, and other financial institutions should also be looking. But of course, the results of these tests will not be used to determine capital requirements for now. So that is important. So going further, based on our market trend analysis, central banks and economic stimulus should become contingent on companies providing evidence that they are accounting for climate risk. So there will be like a big new policy based on the market trend analysis that we just did. So supporting green sectors and penalizing brown sectors for capital requests according to the sustainability risk of the borrowing sectors should be a new policy. And this is a new idea that was put forward by the high-level expert group on the sustainable financing in the European Union. So to finish, I think going over my two claims, energy markets really review how they can make it overall easier to act upon climate change, and some of the market trends that we saw, including renewable investments, return on investments, price of renewables, in the right direction, are encouraging for governments and investors wishing to accelerate the transition. And also specific market trends did, in my opinion, enlight specific policy which would help really accelerate the transition and harness the power of the market. So thank you very much for listening. I really look forward to hear your comments. So all comments are really welcome. And here are the list of references, the complete list of references. So I'm very much looking forward to hearing from you. Have a good day, everyone.